If you listen to the conventional wisdom, you'd probably think Elon Musk is totally safe from some big AI market crash.
Yeah, the thinking usually goes, well, Tesla sells actual cars, right? Real revenue. So it can
Mhm.
fund its own AI stuff, like FSD, no problem.
But that analysis seems to miss the leverage, the sheer amount of financial engineering going on.
Exactly. We've been digging into the source material for this, and it paints a very different picture. Less like a fortress, more like a uh, financial house of cards.
And it's all leaning on, speculative future value.
Right. And if that speculation vanishes, it's not just a market dip.
No, it becomes personal financial ruin. We are actually talking about the possibility of a massive, like $94 billion margin call.
Welcome to the deep dive.
Today, our mission is to cut through the noise, look past the headlines, and really show you how these financial connections make this whole empire, well, uniquely vulnerable.
Especially to what looks like a coming collapse of the AI bubble.
So first, we need to be clear about the kind of crisis we're discussing here. This isn't like a minor correction.
No, not at all. The scenario our source lays out is basically a mashup of the worst bits of the 2000.com crash and the 2008 global debt crisis, a real perfect storm.
Okay, so let's break that down. Part one is the stock massacre, kind of like 2000, 2001.
Yeah, remember that. Even solid companies like Amazon, companies that obviously survived and thrived later, they lost, what, 90% of their value?
Just evaporated. Because the speculative air got sucked out of the room.
And the thinking is we'll see something similar, maybe even worse, for companies riding high on this sort of AI premium valuation.
But the really scary part, the 2008 echo, that's the debt, isn't it?
Oh, absolutely. We're apparently looking at over $1.2 trillion in bonds tied directly to AI company debt.
And the source says these are being rated as super safe, like AAA rated.
Mm-hmm. Which is kind of wild when you think about it. These are companies burning through cash, many aren't profitable, yet their debt gets bundled up and sold as if it's rock solid.
It sounds exactly like the subprime mortgage crisis. Bad loans repackaged as safe investments.
It's the same structure. But what's really staggering is the speed.
Right. Didn't it take like almost a decade in the 2000s to build up around $1.9 trillion in that bad mortgage debt?
Yeah, roughly. And the AI sector. They've hit $1.2 trillion in this, let's say, questionable debt in just 2 years.
Wow. That's terrifyingly fast.
So when these bonds inevitably default in a crash scenario, boom, system-wide meltdown potential.
And the combined effect of the stock crash and the debt crisis leads to what the source calls the Great Capital Freeze.
Exactly. Financial institutions get burned twice, they pull back hard, all speculative investment just stops. Globally.
We're not just talking about VCs hitting pause for a bit.
No. We mean the actual flow of money needed for big, expensive, long-term R&D, the moonshot stuff. It just dries up.
Well, money only goes to safe bets, guaranteed profits, low risk.
Which is basically a death sentence for any project that needs huge amounts of cash before it can prove itself. Speculative R&D is dead on arrival.
Okay, so if this crash basically turns off the money tap for R&D, what's the immediate impact on these newer cash-hungry projects?
Well, new investment, R&D funding, it just vanishes.
No.
Poof. Speculative projects get wiped out almost instantly.
Right, no more runway.
Let's take XAI as the first example. The source kind of frames it as maybe a vanity project, born out of Musk's disagreements with OpenAI.
Mm-hmm.
And like all these deep learning outfits, it runs into that problem of diminishing returns.
Yeah, that's the core issue, isn't it? You can spend 10 times the money training your model, but you definitely don't get a 10 times smarter AI.
Nope. Costs shoot up exponentially, but the performance gains get smaller and smaller. That only works when money is basically free.
So take away the easy money.
And the business model collapses. Now look at XAI's funding. It's incredibly exposed, hugely dependent on outside cash.
Okay, what are the numbers?
Around $10 billion raised through equity, another $12 billion through debt,
Debt, okay.
and then maybe $2 billion transferred internally, supposedly from SpaceX.
But even with that, the math is pretty stark. What's that, like 75% of its funding is external debt and equity?
Exactly, 75%. From investors and lenders who are expecting a massive return, and probably pretty quickly.
So when the Great Capital Freeze happens...
That external money disappears overnight. And the debt, it gets called in.
Uh-oh.
Musk would somehow need to find like 4 times the internal funding just to keep the lights on at the current rate, which seems impossible.
And isn't XAI also tied up financially with X, the platform formerly known as Twitter?
Yeah.
Which isn't exactly printing money either.
Right. That's another anchor. X likely goes down with XAI, adding to the financial pressure personally.
Given that reliance, that 75% external funding, what really happens to XAI's core operations when the plug gets pulled and the debt's called?
Investors want their money back, or what's left of it. Funding halts. That huge cash burn means, immediate bankruptcy. It just can't survive.
Okay, so XAI seems incredibly vulnerable, and that leads us straight to Tesla, the supposed bedrock.
The place everyone assumes is safe because, they make cars, people buy cars.
But that view totally misses the hidden vulnerability, doesn't it? The valuation.
That's the absolute linchpin. Tesla's stock price. It's valued like a high-growth AI company, not a car company.
Because of the promises, right. Full self-driving, robo-taxes, the future stuff.
Precisely. That's the AI premium baked into the price.
So when the AI bubble bursts, market panic sets in, and that premium, it just gets stripped away.
And Tesla gets revalued. Not as a tech dream, but as a car manufacturer. A very good one? Maybe, but still, fundamentally, an automotive company.
And we can actually put some numbers on that potential revaluation, can't we?
We can try. Let's look at a solid, profitable automaker like Toyota. Their price-to-earnings ratio, the PE, is around 8.2, something like that.
Okay, a sane number. And Tesla's projected profit for 2025 is maybe $15.2 billion, and that's already down a bit.
Right, so apply that same PE ratio, $15.2 billion times 8.2.
Comes out to $126.64 billion.
$126.64 billion, which sounds like a lot, but compared to its peak, it's less than 10%. A massive haircut.
That revaluation alone is damaging. But it's what it triggers that's the real killer blow.
Exactly. Musk's personal leverage. The source estimates he's used over half his Tesla shares, about 7.8% of the whole company, as collateral.
Collateral for personal loan.
Yep. Estimated at around $94 billion. That's the money likely used to fund things like the X acquisition, maybe prop up XAI, keep SpaceX R&D going.
Okay, wait. This is the part. Honestly, I still kind of struggle to wrap my head around it. Using stock priced based on maybe someday robo-taxes to guarantee $94 billion in loans to fund other speculative ventures. The level of interconnected risk there is just staggering.
It is. And that huge debt was secured against Tesla's high AI premium valuation.
So when Tesla's value crashes down to that $126 billion number,
we hit what the source calls the margin call apocalypse.
Right, let's pause there. That's 7.8% of Tesla stock used as collateral, which was backing the $94 billion loan. Suddenly, it's only worth about $9.88 billion.
Precisely. The lenders are instantly underwater by, over $84 billion?
Whoa! Just imagine the collateral value tied to what was maybe $1 trillion company just evaporating almost overnight.
Lenders would panic. They'd issue immediate margin calls, demanding the full $94 billion back now.
And he can't sell his other shares to cover it, can he? Because trying to sell that much stock would just accelerate the crash itself.
Exactly. It's a catch-22. Selling triggers the very collapse he needs to avoid. He's financially paralyzed.
So if he's paralyzed, can't sell, can't cover the $94 billion debt, what's the final consequence for Tesla, the company?
He loses his shares. The lender sees the collateral. He's forced to liquidate whatever he can. He loses control, loses his role as CEO. The company survives, maybe, but without him at the helm.
Regardless of how many Model 3s they're selling. Wow. Okay. Mid-roll sponsor read placeholder.
All right, so in this scenario, XAI is bankrupt. Musk has lost control of Tesla. What about SpaceX? The one actually launching rockets, sending astronauts up, deploying satellites. Surely that's safe from an AI crash.
You'd think so. But history gives us a pretty stark warning here. After the 2000 crash, after 2008, what happened to moonshot funding?
It dried up completely. That kind of speculative, long-term, high-risk R&D money just vanished.
And this combined crash scenario, likely even worse for capital availability.
And that capital freeze becomes lethal for SpaceX because of one thing: Starship.
The big rocket, the fully reusable one.
Yeah. It's basically a massive bet-the-company project. It needs a constant, huge fire hose of cash for R&D. It hasn't delivered a fully working system yet.
The cost must be enormous already.
Over $10 billion spent, apparently. And the source estimates the total R&D needed to actually get it fully working as promised. Probably over $20 billion. More.
Okay. $20 billion plus. Can the company fund that itself? What are its profits like?
Well, the reported 2024 profit was only $147 million.
Wait, only $147 million? But what about all the commercial launches? The government contracts, NASA stuff, is that factored in?
It seems to be, yeah. But that revenue, while significant, just doesn't come close to covering the billions needed every year for Starship's development. It relies on external funding. Billions in new investment, year after year.
And post-crash, In the great capital freeze, who's writing those checks for a super expensive, speculative rocket program?
Good question. Probably nobody.
So if Starship development grinds to a halt due to lack of funding, then what?
Then the Starlink domino starts to fall.
Ah, the satellite internet service.
Right. Starlink, as it stands, isn't profitable. Its whole business plan depends on Starship achieving that mythical super low launch cost like $10 million a launch.
Without cheap Starship launches.
The current rockets, Falcon 9 and Falcon Heavy, they're just too expensive to deploy the thousands and thousands of Starlink satellites needed to make the network viable and profitable. The economics just don't work.
Okay, and here's the kicker, right? How much of SpaceX's actual launch activity is Starlink?
In 2024, according to the source, 70%.
Yeah.
70% of all SpaceX launches were for their own Starlink satellites.
Wow. So if Starlink deployment stops because Starship stalls?
70% of SpaceX's launch business disappears overnight.
Leaving them with just the remaining 30% commercial and government flights.
Yeah, a much smaller, likely stagnant market share.
Yeah.
And they'd still have massive debts tied to Starship development they couldn't repay. The valuation would plummet. The financial crash brings down the rocket company indirectly.
Okay, just to clarify then, how much of SpaceX's current operations really hinges on Starship succeeding and delivering those low costs?
A huge chunk. That 70% figure for Starlink launches tells you pretty much everything. It's fundamentally unsustainable without Starship working as planned.
Okay, let's quickly recap the timeline then, the whole chain reaction, because seeing the steps is key to understanding this deep dive.
Right. So, phase 1, the AI bubble bursts, stocks crash, AI-related debt defaults, speculative capital vanishes worldwide, the great capital freeze begins.
Phase 2, XAI and the X platform, starved of cash, go bankrupt pretty much immediately. Musk's personal funds used to prop them up are gone.
Phase 3, Tesla gets revalued as just a car company. The stock price crashes below the critical level for his loans. That triggers the $94 billion margin call.
Mhm.
Musk is wiped out financially, loses control of Tesla.
And Phase 4, SpaceX can no longer fund Starship development. The project halts. Starlink deployment stops because it's too expensive without Starship. 70% of SpaceX's launch business evaporates. The company likely faces bankruptcy or massive restructuring.
So wrapping this up, the big idea here for you, the listener, is interconnectedness. This isn't about isolated companies.
Oh, it's a financial house of cards. The failure of speculative AI pricing doesn't just stay in the software world.
It triggers a massive personal debt crisis for Musk due to that huge leverage against Tesla stock.
And that personal crisis then starves the seemingly unrelated space company, SpaceX, of the capital it needs to survive and fulfill its long-term plans.
Right. The AI bubble bursting exposes this massive systemic risk woven throughout the entire empire, all built on that foundation of speculative valuation and enormous personal debt.
It's quite a cascade.
Indeed.
Thank you for joining us on this deep dive. We explored some pretty complex and frankly startling financial risk hidden within one of today's most talked about business empires.
Yeah, it really highlights what can happen when ventures built on cheap, easy money suddenly face the music, the reality of profit, debt, and actual collateral value.
Before we go, we always like to leave you with a final thought. Building on what we discussed today, if this scenario or something like it were to play out, what does it mean for the global space industry if its largest private player, SpaceX, collapses mainly because of a financial tech bubble bursting? Something completely unrelated to rockets, ostensibly.
It definitely raises huge questions, doesn't it?
Yeah.
About concentrating so much critical infrastructure development in one place, subject to these kinds of market whims. Maybe something to think about next time you're looking up at the sky.
We really encourage you to maybe look into margin calls, how collateralized loans work on this scale, that $94 billion figure. That's really the core of this whole potential vulnerability. Thanks for listening.